Today, we confront one of the most complex standards in financial reporting, International Accounting Standard 12, income taxes. This standard addresses the necessary distinction between your company's accounting profit and the taxable profit calculated by the tax authority. It's the standard that brings deferred tax into play. IAS 12 requires us to account for two components of tax expense in the income statement: current tax and deferred tax. Current tax, this is the tax payable, or refundable, to the government based on the taxable profit for the current period, calculated using tax laws. Deferred tax, this is the anticipated tax consequence, either payable or recoverable, in future periods resulting from the difference between the accounting treatment and the tax treatment of assets and liabilities today. Why do we need deferred tax? Because in almost every jurisdiction, the rules for preparing financial statements, accounting profit, differ from the rules for calculating tax, taxable profit. These differences create what IAS 12 calls temporary differences. A temporary difference arises when the carrying amount, the book value, of an asset or liability is different from its tax base, the value assigned to that asset or liability for tax purposes. Deferred tax is all about recognizing the future tax impact when that temporary difference reverses, which it eventually will. This is called the balance sheet approach to tax accounting. Temporary differences are categorized as either taxable or deductible. Taxable temporary differences. These are differences that will result in amounts becoming taxable in future periods when the asset is recovered or the liability is settled. They give rise to a deferred tax liability. Example, accelerated depreciation. For accounting, you might depreciate an asset slowly, but for tax purposes, the government allows you to claim larger deductions, capital allowances, early on. This means your current tax bill is lower now, but the difference creates a future obligation. The tax base is lower than the carrying amount, signaling future tax payments. Deductible temporary differences. These differences will result in amounts becoming deductible in future periods. They give rise to a deferred tax asset. Example, warranty provisions. For accounting, IFRS, you recognize a liability for future warranty claims as soon as the related revenue is earned. However, the tax authority may only allow the deduction when the actual cash is paid out in a later year. This means your current accounting profit is lower than your taxable profit, and you've essentially overpaid tax now. The tax base is higher than the carrying amount, signaling future tax savings. A deferred tax asset represents that future tax recovery. It is important to note that a deferred tax asset can only be recognized if it is probable that sufficient taxable profit will be available in future periods against which the deductible difference can be utilized. How are deferred taxes measured? They must be calculated using the tax rates that are expected to apply when the temporary difference reverses. Critically, this must be based on rates that have been enacted or substantively enacted by the reporting date. In the Statement of Financial Position, deferred tax assets and liabilities are generally presented as non-current items, and can often be offset against each other if specific criteria are met, primarily relating to the same taxing authority. The ultimate goal of IAS 12 is to ensure the matching principle is applied to income taxes. The total income tax expense shown on your income statement, which is current tax plus or minus deferred tax, should logically match the current period's accounting profit, regardless of when the cash is actually paid to the tax authority. By applying IAS 12, we provide a true and fair view of a company's performance, properly allocating tax consequences to the period in which the related income and expenses were recognized. Like and subscribe if you're looking for more content on accounting, tax, or audit matters.